All right, let's talk some Tesla. The stock's getting hit right now, but the stock was also pretty darn expensive coming into the report. Let's look at it from the credit side. Nishit Madlani joins us from S&P Global Ratings, Auto's managing director. Nishit, thanks for joining us this afternoon. Good to have you back on the show. When you look at the stock price, obviously Tesla's getting hammered, but that's in the equity world. Does anything change in your calculations on what this company is worth?
No, first of all, thanks for having me. Look, from our perspective, when we think about the fact that several companies have been pouring billions of dollars towards the vision of operating a fleet of autonomous vehicles for over a decade, this is not new. What the event did was it helped bring that vision to life. But from a rating standpoint, to your question, the disclosures were not really sufficient to build any upside in our ratings model yet. Investments in self-driving from the credit world, are a drag on cash flows. And the only time when we think about upside is if we think there is visibility in terms of gaining widespread regulatory approval. We're not quite there yet. Luckily for Tesla, it's not a huge drag on ratings because they have enough liquidity and access to capital to fund these investments.
Now, the access to capital, I was kind of thinking the same thing because the show was pretty spectacular yesterday. They're on the Warner Bros. Lot and everything. They're not hesitating to spend right now to make a big deal of this. And some would argue that the robos, both the Android and the car, and now the van too, that this is really the only way to justify their equity valuations. But to your point about, I guess, from the credit side, it's a little bit more like binary to some degree. Are they running or are they not? Are they pretty smoothly running still?
Yeah, so what I'll say is, look, from the standpoint of the rating, we actually look at the fact that they're facing a lot of pricing pressure globally in the US.
Yeah.
The Model 3 has lost steam. The Model 3 volumes were down 40% so far this year. Shares down almost 7 percentage points. It's kind of expected, but they need to keep investing in R&D for the planned product roadmap that they've promised. So if I had to pick the most important rating factor, it's got to be the timing and success of its next generation, more affordable vehicle. They talked about it on the last earnings calls. They said it's on track for start of production sometime in the first half of next year. So from our standpoint, that's a very important consideration for market share and, of course, our view of its competitive advantage beyond 24 and 25. So from our standpoint, that's the next transformation chapter, the post the Model 3, Model 5 production overhaul. The next one will be the affordable vehicle, not the robotaxi.
Okay. And it seems like the past year in particular, the margin story, the pricing power that basically all autos lost, not just Tesla, because, their margins are still better than the legacy ones, even after all the pricing cuts, aren't they?
That's right. Yes. And yes, we did take down some of our pricing assumptions, which led to their margins declining. But if you compare it to the automaker average, on an average, the automaker EBITDA is roughly, for an investment grade company, it averages between 10 and 12%. By our forecast, Tesla is north of 13% in our forecast. So yes, even with these price cuts, as of now, it does have cushion as far as the rating is concerned.
Okay. So those who are arguing that Elon's going to blow up his company by investing in these offerings right now, that's a little extreme. Fair enough. The risk reward is still worth it if he can actually, get a major competitor to Waymo in major cities. It seems like that could be a huge source of revenue if it all works.
Yeah, any potential updates on how they're able to license this, work with partners, get more widespread regulatory approval, all of that is an upside. For now, these investments appear sustainable based on their cash. But again, from our standpoint, the next important ratings driver is really going to be the timing and the success of its affordable vehicle.
Okay, that's a way bigger factor. Totally get that. Okay. So Nishit, I'm also kind of thinking, if we think outside the box for a sec, just because I still got the cyber van on my mind and all these things. One of the ideas is that, you and I go buy one of these cyber cabs and kind of run it like an Airbnb, basically. Do we know how that would function for Tesla? Would they take a cut of anything? Would it just be a one-time sale and then they're out of the picture and then the consumer runs it on their own? What if the thing gets in a wreck? Are they going to be liable for fines? Do we know any of the potential kind of phase 2 of how it would work for Tesla?
Yeah, we don't specifically know it. Some of the disclosures around timing for monetization, what hurdles need to be cleared, even with the regulators state by state. even in terms of technology, how many miles, before intervention, what's the benchmark versus others like Waymo? So look, my sense is that we need a little more details. As of now, if you think about the fact that automakers have been focused on this world for over a decade, so it's not the first time we are hearing this concept of a shared vehicle, but bringing it to life and making sure that the assumptions on the cost per mile are clear, and more details around the battery range. Without all that, it's very difficult to paint a realistic view as to what this would mean from on the ground monetization.
Okay. So that's all still up for grabs, basically. But for now, they've got the cash flow to dabble in the CapEx for this. The last part is it prohibitively expensive to do this right now, Nishit? Like, if they don't really take off, are they going to have to, is it going to strain their bottom line? To what degree is it straining?
Yeah, I mean, it depends. They haven't really disclosed the actual dollar amounts that's going specifically towards this initiative. But over time, if, cash flows in the fundamental business, the market shares keep getting eroded. We don't have, timeline or visibility on success of the affordable vehicle. And at the same time, money keeps getting poured into this, all those things coming together, that's when we would start getting worried about the cushion for its current credit rating. But as of now, I think over the next year or two, it looks as if they should be able to manage cash flow.
Thank you very much, Nishit. Appreciate the analysis.
Thanks for having me.
Nishit Madlani, Otto's managing director at S&P Global Ratings.